a story that came out yesterday, and which is by the way of India's balance of payment, or the CAD, current account deficit, that is widened at least sequentially quarter on quarter.
Yeah, so that's what, Shweta, I think, the story is positive when you look at it. The CAD narrowing on a year-to-year basis from about $18 billion, it has narrowed to about $9 billion for Q1 of last year versus Q1 of this year. So you see narrowing on a year-on-year basis, but you see a widening on a sequential quarter-on-quarter basis. Now, what do we attribute this to? I think this widening on a quarter-to-quarter basis has happened on account of trade deficit widening, on account of remittances from abroad reducing, and the surplus that we enjoyed on net services, whether it was IT-linked service exports or or whether it was services of any kind. We've seen that while services happen to be in the surplus and manufacturing in the deficit in India's recent history, in fact more than recent history, we've seen that that trade deficit and surplus that we would get on account of services exports has reduced, and that is something that I think got reflected in the quarterly earnings of the IT sector companies as well. That discretionary spending by giants in the US who give business to India's IT companies had shrunk, and that got reflected in the CAD on a sequential basis narrowing as well. Now, what is this really leading to? I think what we are trying to arrive at is that by the end of this year, the financial year closing FY24 will see CAD staying pretty much in line of about 2 to 2.1% of the GDP. So when you look at the numerical value of current account deficit would balloon from about $60 billion or so last year to about, or $63 billion last year to about $75 billion by the end of this financial year. But as a percentage of GDP, remember GDP is also growing. So while the absolute number grows, as a percentage of the GDP, we are likely to be in a comfortable range of about 2% or so.
All right, so nothing much to worry there.
So mixed cues, like I said, there is going to be pressure on the INR because of this widening on a quarterly basis. So, the demand for purchasing rupees internationally would be lowered. So there is going to be pressure on the INR. Oil prices rising, not going to aid any economy, not India definitely. So that is going to be something which is going to further add pressure on the current account deficit. But then we are also seeing GDP growth numbers adding up. So overall, you are seeing manufacturing activity picking up. You will see hopefully a better agriculture season. You will start seeing export of rice restart hopefully in the month of October. Yes. So all of those export items, and even despite inflation in US, we've seen that that the US Fed has paused its rate hike cycle. If that were to continue, we will see more capital demand being more money available in the hands of corporates in the US, and some sort of spending to open up again for the Indian IT sector.
And in fact, various Indian ministers have reiterated, including Piyush Goyal, that exports will pick up. Is there an indication there the exports are picking up, Suyash?
I mean, across various sectors, we have seen exports picking up, of course, on a year-on-year basis. But I also want to talk about this deficit situation. Now, India's fiscal situation will come under scanner because, the recent inclusion into India of government bonds into the JP Morgan index. Now, currently, the foreign participation in Indian bonds stands at about 2% or so. After the inclusion, it will jump up to 4%. Now, FTSE is also expected to include Indian bonds in its index. It has a AUM of about $1,400 billion or so, and then Bloomberg is also expected to follow. So, and India's fiscal deficit currently stands, the highest in terms of in relation with GDP among the 20 countries that are tracked by Bloomberg. Okay. So I think the fiscal situation will need to be monitored because that the increased exposure to global events, because if foreign investors scrutiny will definitely increase to Indian markets. So this is a number that certainly the government would need to manage.
Absolutely right. But I think this inclusion in various debt instruments, bond is going to only happen in the next financial year, right? So I think this year the CAD story at about 2% of the GDP should not be a cause of concern. I think what this will eventually need to bolster is more manufacturing happening in India, more capital investments by private sector coming in India, and the consumption story staying robust. If these three are managed well, I think our fiscal situation should also be under control, and whatever surplus we get by way of investments through debt instruments into Indian bond markets, I think is only going to further shore up the rupee, which may be under pressure because of the vagaries of oil prices, etc.
All right.